Hello and welcome to the Plain English Finance podcast, the podcast dedicated to helping you make smart financial decisions. You just asked what this one was about. This one is about the war chest, the retirement war chest.
Interesting. I have no idea what that means.
You'll know as soon as I start talking about it.
It sounds like a video game thing. Go find the war chest.
Maybe. Okay, so what is the technically right way to invest? Allocation-wise. Bonds, lots of bonds.
Oh, technically 100% equity.
Correct. Unfortunately, we're human. And the reason that unfortunately, we can't invest
I
like
wish
that,
we weren't human.
or like robots. So while that is statistically the right way to invest for the lowest throughout your entire life, no matter what stage you're in, for the lowest risk of a bad outcome, it's unlikely to allow somebody to stick through it for the long term. So what I do is build a plan for when something bad happens. Mm-hmm. Okay, and that is an important thing that everybody should have, because the markets are going to crash at some point during your lifetime, probably multiple times, and you need to have a plan for what you're going to do when that happens. And when you're in retirement, what you do is a little different, and it's a lot scarier, because when you're working, if you're in a career that is pretty stable, let's say you're a nurse, right? Or I work with a lot of engineers, let's go with engineers, or something like that isn't strictly tied to the markets, you will have your income, right? It's a little different for somebody like me. If the markets crash 50%, and because I charge a percent of the assets that I manage, right? So my income drops 50% if markets drop 50%. So I need to be more careful than the average person. But or real estate agents, another good example, they do very well when the markets are booming and people are spending money, and when they're in the middle of a financial crisis, people aren't buying tons of houses, so their work dries up, right? So unless you are in a high risk profession like that, where you're very tied to the markets, you'll probably just keep working, and it won't matter to you at all that the markets are down 10, 20, 30, 40%. But when you're relying on money, it's a lot more concerning.
Like in retirement?
Yeah, when you're relying on the money. And I don't want to say in retirement, because it depends on what part of life you're in, but just oftentimes it's retirement. But yeah, when you are relying on that money to put food on your table, it is a lot scarier when markets drop.
Yeah.
So you need to have a plan for what you're going to do when that happens. Mm-hmm. What I like to do as part of a plan can be to hold cash.
Cash wedge.
That's the war chest. Yes, that is the cash wedge, that people call it various things. That's when it hits the fan, we have this. Mm-hmm. And the price of that is very often going to be a negative impact on your overall portfolio. It is more often than not, you holding that cash wedge, you would have been better off if you'd invested it and just
bit the bullet.
And still taken out even when markets are down. Like, technically, we're human. It is very difficult to do that and understand that. If I help somebody grow their portfolio to $1 million and the markets drop 40%, that is $400,000. It doesn't matter to them that if they hadn't been invested that way, they would only be at $600,000 now anyway. Nobody cares. The only thing they care about is that it used to say $1 million and now it says $600,000. That is what they care about, right?
I think we talked about that, where it's the moment it gets to the highest number, that's the number.
The whole numbers are the worst as well.
Yeah.
Because the amount of people, the portfolio passes $1 million, and I always get the message, I always get the email, I passed $1 million. It's, because it's a big moment for a lot of people. So I get that. And then I'm just thinking to myself, please don't drop 2%. Please don't drop 2%.
Well, or please don't check until next month or 3 months later, because you said the markets are changing all the time.
Yeah. A 2% change in a day is another day in the market, but that's $20,000 on $1 million portfolio, right? I was at $1 million. Now I'm back down below $1 million. Anyway, people get tied. It's called anchoring bias. Anyway, that aside, so I need a plan to keep somebody invested during those timeframes, because we know it's going to happen. The issue is, what do we do about it? So war chest, cash wedge. How much do you think we'd keep in this?
We're just, I kind of want to say something to do with expenses similar to an emergency fund. But I would guess a little longer than 3 months.
But that's what I like about what you just said is that you didn't use a percentage, because percentages are irrelevant to the amount that I would keep. It is not about a percentage. It is about time, especially with the way that I'm invested. I am a market investor. I invest in index funds, that type of thing. So it's not a case of if it's going to recover. We know from history it's a case of when it recovers. How long is it going to take to recover? That is the real question. How long is it going to take? So I need to buy myself time. So it is about time. And that is how I help people determine how much we're going to keep in the cash wedge. And the last episode was, or not the last one, I guess. One of the previous episodes I've spoken about is cash flow management. Guess how it's very easy to determine the time if you manage your cash flow well, right? So in that episode, I gave the example of $120,000. If I knew it was costing me $120,000 a year to do the things that I want to do, then I know that's 1 year. If I choose to keep 2 years, because we'll have this conversation, 2 years gets you through these type of events. Allows the 2 years allows the markets to recover in these type of events. 3 years allows you to recover in these type of events. And however long we decide time-wise is how big the cash wedge is. And it doesn't increase the more that markets go up or as the interest is earned or anything like that. It's based on time. I want to give us 2 years, 3 years, 4 years, 5 years, whatever the time frame is that we decide. That is how much cash that we keep. And that depends on how much you spend, how big the portfolio is. It depends. It isn't a percentage that we pick out. It's based on you and your life.
Yeah. Which again is the whole reason you're always stressing the fundamental of cash flow management, because it really does revolve around every decision.
It does. Because if I say to you, if we pick $100,000, right? I'm going to say we keep $100,000 of cash. How does that actually help me stay invested to the investment strategy? It doesn't. What if I need that $100,000 of cash tomorrow? All right. What if that only lasts me 2 years, and I'm terrified that this crazy event is going to last 5 years, right? Not knowing how much you're spending a year is detrimental to you feeling confident that you can weather this storm. Now, I say that this is the war chest is what I use. That is part of the plan of what ifs, right? So what are we going to do? Another plan for some clients where they're pretty aggressive, and the plan is to sell the land, right? They have land, they get rental income from the land. They know if we sell the land, we're going to get X amount. That can be part of the plan if something crazy happens, right? For some people, the plan is to start CVP earlier than we would otherwise want to. Start government pensions and things like that. That means that $100,000 that we left, maybe that now lasts 3 or 4 years if things are looking really, really scary, right? So it just has to be, you just have to have a plan to know what you're going to do if this happens. For some people, it could be reduced spending.
Yeah.
Right. There's other clients that's the plan. The plan is we're spending this amount now. We know our spending is high. We know that it's not sustainable if the markets crash. If the markets crash, we will cut back.
Yeah.
Right? That's an okay plan as well. The important part is you must have a plan. No matter what you're doing, no matter what stage you are in life, it's just much scarier to the individual during retirement. But this counts across the board, especially with the way that I invest, because I recommend people invest what they need for the vehicle, right? I don't recommend people save for specific things. So it's a case of if we needed a car and the markets were down and we really needed one, what's the plan? Well, for us, we have debt that we can access, right? That's the plan. That is the price that we'd pay. It's unlikely to happen, but it could happen. If we need a vehicle, I have to get a car loan. That can be part of the plan.
Yeah.
You just need a plan.
Yeah.
Okay. And that is the war chest. That is how the fundamental building blocks of a resilient retirement is certain types of assets are good for certain things. If you use the assets for the right thing, equity is good for growth. The price is ups and downs. We know that. We don't hope that the ups and downs don't come. And then when they come,
No,
we're
we
like,
hope the ups come. We hope the downs don't come.
yeah. But that's not how we build everything. Just cross our fingers and hope it doesn't happen.
Hey,
Like,
that's a great strategy.
no, it's a terrible strategy.
That's my chess strategy. Don't you remember?
Hope chess. Yes. That is you hope the person doesn't see it. It's like, no, you can't play chess hoping that the individual doesn't see what you're trying to do. You have to play chess knowing that that individual is going to see what you're trying to do and can't do anything about it. That's how you play chess.
Why, maybe he won't see his queen is under attack.
Not the way to play chess. It's a great attitude. It's the same way with the markets. There's not how you navigate the markets. You can't hope that bad stuff doesn't happen. You have to plan for what we're going to do when it does happen. Mm-hmm. And that part of that can be a war chest. Can be the way that I build retirements. Even for me, I say to myself, I hope I can be 100% equity investor throughout my life. I'm very likely when it actually push comes to shove, probably keep 2 or 3 years of cash.
Yeah.
I'm not going to keep anything else, right? I'm going to be very high equity content. Probably won't hold bonds or very many bonds. Definitely won't be holding. What a lot of people do is they will hold higher risk bonds.
Oh yeah, we talked about this.
Which blows my mind. So their goal is that I'm a low risk investor, so I'm now going to hold risky bonds so I can get 5% in bonds instead of just holding higher quality equity where you're more likely to get that. It's just scary. And that's something that again happened in 2008 when people this piece of your portfolio, the fixed income piece of your portfolio is there to, if the equity piece drops or when it drops, it's your safety net. Keep it in safe assets. Mm-hmm. So this cash wedge, I like GICs for it.
Wow.
You know,
everyone just take a moment. Tré
I just said that. Yeah,
GICs.
Yeah, I want something really, or I'll use investment grade bonds or something like that. High quality investment or government grade bonds or something like that. But the goal is short term safety, and I know that bonds long term are more risky than equity, but that is a trade off I'm willing to make for the mental
peace of mind.
I know I have my plan. I know what I'm going to do. When it happens, I'm still going to be scared. I'm still going to be panicked. The world's still going to look like it's on fire, but I will be able to stick to the plan.
Yeah. Stick to the plan.
That's all it is. That is the war chest.
Yeah, I like that. I've already talked about this story before where you started in your career. And I immediately asked you, what if the markets are down and someone's in retirement? And your response was, we plan for it. And I was like, wow, that's a great answer.
That's a great idea. Maybe I should do it. Yeah. It's like you can't go through retirement expecting it not to happen. Right. If you do, you are setting yourself up for failure. It is much better that you plan for what you're going to do when it happens, and then you leave your plan there. Because the worst thing to do would be, I'm scared about what if it happens, and then I'm over planning. And there's definitely those people where I have clients that I've brought on where they are worth millions of dollars of financial assets, and 90% of it is in cash or GICs and things like that. And I get the allure of it, but you are opening yourselves up to other types of risk.
Yeah.
So just because it looks safe doesn't make it safe. You wanna make your decisions based on what's going to give you the lowest chance of a bad outcome, which means that you should be very heavy equity for your entire life, right? But heavy equity doesn't mean 100% equity.
Yeah.
It means that you have to have a plan. But when things blow up, when things go wrong, because they're going to go wrong at some point.
You know, I just wanted to add, I follow this guy on Instagram, and he just made a post about people giving up on their New Year's resolutions. And this is reminding me of it because there's a theory, and of course I can't remember probably the most important part. It's an acronym, but part of it is making that statement. If this happens, then this. So he used the example of working out because that's what a lot of people do in the new year. They want to start working out.
Didn't you just say you got a gym?
Yeah, I know. I'm like, am I basic? Oh, no. No. Anyway, he said, so you mentally prepare for obstacles. Okay, so some obstacles are going to be after work. I'm really tired. I don't want to go to the gym because I'm tired after work. So you start by saying, if after work I'm really tired and don't want to go to the gym, then I'm going to put on my workout clothes and do a 5-minute warm up with no obligation to do anything. That was the example he gave. And that reminds me of this. And it increases success a ton because your brain is wired that way to, of course, most people, once you do that 5-minute workout, let's just get it over with, right? You've done kind of the hard part, which is that mental, just do this one thing. But
you plan for the obstacles instead of hoping the obstacles don't come.
Yeah. Or even it's the same, again, it's the same saying that you have where closing your eyes doesn't make the demons going away. Just pretending like there's no obstacles going to come, or, I really hope that
doesn't make it true.
Yeah. I hope that I'm just going to love mornings and start working out at 5 a.m. I know that about myself, that is never, ever going to happen. So I've planned for the obstacles. Okay. What do I need to do to make it actually work?
Yeah.
So anyway, sorry. Oh, I'm sorry I'm boring you.
No.
I'm just kidding. I was trying so hard not to yawn. We're tired over here.
Yeah. And saying that I didn't go to the gym after work, so maybe I should plan for that.
Well, I'll go find that acronym for everybody that Tré needs it. Just kidding.
Yeah. No, that's a great example because I think because the amount of people that ask me that, what are, like, that's their biggest fear, is investing money and it dropping. And it's like, there's very little I can guarantee you in this industry. Yeah. I can guarantee you that that's going to happen. I can guarantee you that you're going to invest money and at some point it's going to be worth less than the day it was before.
Yeah. Promise.
No, I promise. I pinky promise. It's going to happen. It's not a hope it doesn't happen. It's going to happen. Right? It's a guarantee that is going to happen. So you have to plan for what you're going to do when that happens to a big degree, when that happens seriously, when something major happens. But that also feeds into the investment philosophy. And that feeds into why I don't make bets. I had a conversation with somebody the other day that they were invested very heavily into cannabis when it first blew up, and they lost a lot of money before I was involved in their stuff. And then they said to me that they ended up buying some resource stuff and it did very well. It lasted a while. And they said to me, okay, well, we're going to put this extra money in. What should we do with it? And my response is the same thing that I say to everybody. I do not take bets. Global equity fund. Global whole market index type fund. That's my recommendation, right? This was long-term money. That's my recommendation. Doesn't matter what's going on with geopolitically. It is an investment philosophy that has worked time and time and time and time again. And because it is a decision that you can make time and time and time and time again, even if that person is right and they guess that silver went up is going to go up a ton, and they get this one right, maybe the next one is wrong. Maybe the one after that is wrong. The fact is I have averaged over the last 5 years of investing market returns, right? It's 13, 14, 15% or whatever it is in the portfolio. I would have had to be right a lot in order to match those returns consistently.
Yeah.
Right? Over the long run, the markets have returned about 8% or so.
Yeah.
I would have to be right a lot in order for me to outpace that. The easiest decision, the most likely right decision, is just going to be to make the right decision that's being correct.
Based on the data.
Based on the data, right? Then I can focus on other things and optimize them. But as I said, make decisions that you can stick to and think about the consequences beforehand. For the stuff that is likely to happen, plan for it. It's as simple. It is really as simple as that. It sounds scary, but it is. I don't know how else to.
Yeah.
Don't know how else to stress it. Keep it simple.
Yeah.
But anyway, that's the war chest. So the cash wedge is part of the war chest. But the war chest can be lots of different things, lots of different tools that you can put in the war chest.
Quick question. Why is it called a war chest?
Well, do you know what a war chest is?
No.
Okay, it's like what like ancient places would have if you're under siege or whatever, or if you have to go to war, it's what funds that. So when things get really bad, it's your backup plan.
Okay.
It's what you do when it's hit the fan and you need something to rely on. Everything else has kind of failed.
So what you're
At
saying,
least I have my war chest.
it is a literal chest.
Yeah, it used to be a little chest.
So
with
what you're
jewels
saying
and stuff like that.
is I was completely right at the beginning when I said it sounded like a video game thing, because that's when a lot of video games.
You think it's Zelda? Just a chest.
I might have been thinking Zelda. I might have been thinking
Maybe
something else, but
yeah, that's why it's called the war chest. It's just.
I just know so many audience members are thanking me for asking that right now. Just kidding. They probably all knew and they're like, oh my gosh, end the episode.
Probably. Okay, perfect. That's everything. This is a shorter one.
Yay.
Sweet. Good. See you in the next one.
Bye.
Thanks for listening to this episode of the Plain English Finance Podcast. Tré Bynoe, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities are offered through Aviso Wealth, a division of Aviso Financial Inc.